All right, today is Sunday, October 24th. This is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight. It's going to be a long one. Lots of charts coming out of your eyes, charts coming out of your ears, charts coming out of your wherever. Charts. Why? Because we're going to go over earnings and our regular charts. But folks, the news cycle is moving rapidly. On Friday, we get a town hall with President Biden. And he made a mess out of himself, stumbling all over the place, and it looks like he's losing control over this budget deal. What does that mean? It means that either number one, kicking the can down the road is not going to work anymore, and the U.S. will indeed default on its debt, or he's going to get a lousy deal that adds trillions more to the budget deficit and achieves nothing at all in tangible infrastructure spending, which will be bad for the stock market. We have another leader losing control, Jerome Powell, who made a complete asshat out of himself on Friday talking to the Bank of Settlements, and he remains in denial as the evidence right in front of him becomes clear as daylight that he's losing control over inflation, over this market, and over this economy. Yet the man continues to be in complete denial and total delusion. We have another leader, Dr. Fauci, your boy, Saint Fauci. He's losing control over this pandemic, and now we have more revelations that his agency funded the Wuhan lab and funded torture of dogs. Absolute disgusting stuff. On top of that, we have the Treasury Secretary, who did an interview in the morning with the State of the Union on CNN, and she continues to be in complete denial, total delusion, saying that we continue to believe this inflation will be transitory. Lady, it's not transitory anymore. The evidence is right in front of you. Hashtag empty shelves Joe. I'd love to see hashtag empty shelves Jerome and empty shelves Janet. All of you guys have to be held responsible. And isn't it funny that we have these senile, demented old bats in their 70s and 80s leading the country, and they're not going to live with the consequences? Is Jerome Powell going to be alive 10 years from now? Is Joe Biden going to be alive 10 years from now? How about Janet Yellen or Dr. Fauci? None of them will be alive 10 years from now. And I say with all of this mess, prepare for inflation to rage out of control in the next few months. And probably the pandemic will also rage out of control in the next few months. We even have billionaire Twitter founder Jack Dorsey, and he says prepare for hyperinflation. Of course, the problem with Dorsey's solution is he thinks that the tulip market is the solution for hyperinflation, which is another disaster waiting to happen. The only hedge proven against hyperinflation is the commodities market and food. Food prices are surging out of whack. And guess what? You want to talk about the supply and demand? The demand continues to rage out of control. The supply is nowhere to be found. You're not going to be able to print 3D meat. You're not going to be able to print 3D peppers and tomatoes and eat them. You're certainly not going to eat grapes as an NFT. The largest producing state of food in this country, the state of California, is facing a mega drought, a biblical drought. And yes, we're about to have a significant storm tomorrow, which will be mainly in the northern side of the state. Much needed rain, but it's not going to be enough to reverse this mega drought. When we talk about billionaires sounding the alarm, let's go back to 1929. What was the cause of the crash? Everybody thinks about it. Everybody published studies about it. But what was the real reason for the crash? The real reason is excessive hyper bullish sentiment. The billionaire walking in Wall Street goes to the shoeshine boy. The shoeshine boy starts to give the billionaire stock market advice, stock market tips. But what does the billionaire do? He goes right away, calls his broker, and says, you know what? Dump everything. And that's how the crash happened. We have billionaires right now, the likes of David Tepper, for example, who is a market maker, a whale. When this guy wakes up in the morning and he looks at the mirror, he sees an image of a whale. This guy says, you know what? I'm not excited about this market at all. I don't see anything to buy here. And the question is, when will Tepper and his buddies start to dump? They're certainly not going to let us know. We will know after the fact. And therefore, the dance floor remains hot, courtesy of DJ Powell. But the dance floor is about to catch on fire. When everybody rushes to the exit door at the same time, some will make it out, but the majority will either die by stampede or getting burned alive. Meanwhile, before the fire starts, DJ Powell and company, they go to the VIP tables and say, you know what, Mr. Tepper, it's time to get out and stop dancing. These village idiots will get caught with their pants down and the music will suddenly stop. The market continues to be in hyper-bullish sentiment, in complete denial about all of these facts. The fact that we have a president losing control over the economy. Biden is toast. Powell is toast. Fauci is toast. Yellen is toast. Is the market even paying attention to what's going on? Of course not. They continue to be in this delusion that Powell and the Fed will have their back. Hello? The Fed already lost control. They're going to have to raise interest rates abruptly to control this hyperinflation. Anyhow, folks, we're going to talk about all of these issues and a lot more in other videos. Bear with me here. This is a one-man operation, but I'm going to get all of these videos out for you. We're going to do catch-up. But for now, I want to concentrate on earnings because this is the immediate threat or hope for the market. It's a make or break kind of week. And therefore, we have to look at all of these earnings and set our expectations accordingly. And here it is, the earnings calendar. On Monday, we have Kimberly-Clark and Facebook. On Tuesday, we have UPS, 3M, Visa, Microsoft, and Alphabet. On Wednesday, we have Boeing, Coca-Cola, McDonald's, General Motors, and Ford. Thursday, we have Merck, Caterpillar, Starbucks, Apple, and Amazon. And lastly, on Friday, we have ABBV and Chevron. Of course, we have many other names reporting, but these are the most important names, the market makers kind of names. We start with the most important earnings report perhaps for this season, and perhaps one of the most important top 20 earnings in stock market history. I don't mean to exaggerate here, but the earnings report from Facebook is the most important report we're looking forward to. It is the make or break moment for the market. We had a massive warning from Snapchat that the advertising revenue is collapsing due to many reasons, of course. One of them is inflation and the supply chain woes. Another is the new rules from Apple. We will have the validation whether Snapchat is lying and just trying to cover for their own woes and shortcomings by blaming Apple or not. The vindication or the negation will come from Facebook's earnings. If Facebook's earnings are impacted, then we have a massive problem here. Number one, inflation and the supply chain shortages are driving down ad revenues. Number two, perhaps the rules from the iMob Apple is impacting the revenues for these companies. And this is what I'm looking for in Facebook's earnings. We will go back all the way to the earnings report last year, September 30th. This is the same quarter, only coming from last year. My eyes are laser focused on the advertising revenue year over year, the ratios. Look at this number, 22% growth year over year. This is last year, of course. And here's what happened the next quarter. The ad revenue grew 31% year over year. We move on to the next quarter. The ad revenue is up 46% year over year. And lastly, the most recent quarter, the ad revenue went higher by 56% year over year, indicating that Facebook is a growth monster. The problem is, if this number comes below 56%, year over year, then we get a massive problem, not just for Facebook, but for the entirety of the market. Because we will have validation of Snapchat claims that the ad revenue is going down because advertisers have nothing to sell. Nothing is moving through ports. There is no reason to advertise. They have to cut their ad budgets. On top of that, perhaps the App Store policies are also impacting revenues down. When it comes to Facebook, it is a value name, considering the growth. You can look at the forward PE ratios. Again, they're on par with other big cap technology names like Google and Apple. But when we look at the PEG ratio, when you consider growth, Facebook is really cheap and undervalued. So here comes the battle of expectations. On one hand, there are folks who believe that Facebook will surge higher after earnings because we will find out that Snapchat has its own problems. Facebook remains a monster of growth, and on top of that, it is extremely overvalued and oversold, and therefore we will see Facebook popping higher. There is another school of thought that says, forget about it. We're reaching a peak here in the cycle. Advertisers will not advertise anymore. They will cut the budgets. On top of that, the App Store policies will impact Facebook the most. And this hyper growth that Facebook experienced the last few quarters will not be replicated this quarter. We will see. Now, when it comes to the charts and the technicals, this is what I said about Facebook on October 13th. From a daily chart perspective, the name is beaten down severely. And we have extreme oversold conditions here on the momentum indicators, the RSI and the MACD. Therefore, we're waiting and anticipating a pop higher, a short covering rally. The problem is, whatever rally it is, it could be just an ABC pattern and the bearishness will resume in Facebook. Because on the weekly chart, the pain just started for this name. The momentum indicators are moving down from extreme elevated levels, meaning that the correction is not over in this name. But on the daily, we're waiting for a relief rally, a short covering rally. And then the shorts will pile on Facebook again and drive it down. Here's a monthly chart for Facebook, by the way, and it is trading on a very steep trend line. The likelihood is this line will be broken, and as you can see, the MACD indicator is topping for now. So on the weekly, on the monthly, the picture is not good for Facebook. On the daily, it's okay for a relief rally. And here is what the chart looks like. This is, of course, the daily chart. It is no longer oversold. We had the pop and the reversal. When we look at the weekly chart, what do we see here? The sell-off just started, and it could intensify in the next few weeks. We have a clear trend line, and it appears that the chart wants to break the trend line. And if it does, then we have severe losses to come. Again, it's all about the ad revenue. If it comes out clean, then the market will be vindicated and it will be saved. If it fails and comes out short, then we will have a massive problem. Because if one of the cheapest names in the market right now fails to deliver on growth, then what do you think other names will do? A miss on Facebook. I'm not talking about the analysts' expectations, some douchebags who made up some numbers. No, I'm talking about my expectations, which is the growth rate year over year. It has to come out exceeding 56% year over year, or very close to that number. Next, we have Kimberly-Clark. What's going on here? This is a consumer staple giant, and they have a significant pricing power. The problem is, it is also one of those pandemic beneficiaries, where margins and revenues, net income surged significantly higher last year. This was the outlier, and now that we have more of a normalizing economy, those margins and those prices are going down. For example, in the last report, when we look at the different segments of the business, we have personal care. The net sales were up 13% year over year, but consumer tissue, which surged higher during the pandemic, these numbers are very difficult to live up to and match, and therefore the net sales were down 13%. When it comes to KC Professional, this segment was up 6% year over year. All in all, the net sales were up 2% year over year. Here's the problem. When it comes to margins, the operating profits were down 13% for personal care, down stunning 54% for consumer tissue, and down 29% for KC Professional. All in all, the operating profit was down 34%. Now, when we look at the overall picture for the company, net sales were up about 2% year over year. On the other hand, the cost of products sold were up 14%. And therefore, when you have your expenses rising at a higher pace than your revenues, you got a problem. And therefore, the net income was down 41% year over year. The big question here for Kimberly-Clark is, were they able to jack prices higher during the Delta surge? Did we see a recovery in the tissue business, for example? And what about inflation? They certainly have the pricing power. Are they going to flex their muscles or not? These elements are what's going to make or break the stock. When we look at the technicals, for example, not looking good here. This is a weekly chart. We have what it appears to be a head and shoulder formation, but this is a steady Eddie kind of stock, and you buy it for the dividend mostly. So once again, you have to wait for the report. If the report comes out clean, you might want to consider buying Kimberly-Clark for a dividend. But you also have better alternatives, like Procter & Gamble. They deliver more than Kimberly-Clark, and they also pay a steady, guaranteed dividend. Moving on to Tuesday, we have UPS. Let's start with UPS because the stock crashed in reaction of the last report. So let's see what's going on here. What went wrong in UPS's earnings? The revenue, and by the way, these assholes sometimes they don't include the ratios in the reports. They get paid hundreds of thousands of dollars, if not millions. Is it too much to ask to include the ratios in the reports? Anyhow, the revenues were up 14.5% year over year. I'm looking at compensation and benefits. This is the labor cost. It was up 4.5% year over year. And fuel costs were up stunningly, 83% year over year. And the assumption is fuel costs will continue to eat margins away from UPS. All in all, the operating expenses were up 10.5% year over year. You have the revenues growing 14.5% year over year. You have operating expenses growing 10.5% year over year. The revenues are exceeding expenses when it comes to ratios, and therefore the net income came out fine, up 51% year over year. So why did the stock crash last time around? Here's why. When we look at the different segments of the business, we have the freight segment, which was down a stunning 59% year over year. The market freaked out. They looked at the massive haircut in freight revenues as a warning sign that the business will slow down as the economy continues to reopen. The problem is, after this report, we got the Delta surge. So are we about to see a rebound in freight revenues? And will that be enough to cover the surge in fuel costs? This is what I'm watching for. And by the way, when we look at the technicals on the chart, the market is already factoring in that freight revenues will rebound and it will cover for the rise in fuel costs. Last time around, we looked at the chart, it was in a bull flag consolidation. That played out to the upside, a massive pop higher, and now it is consolidating in a sort of a megaphone pattern. But you see that pop 3 weeks in a row, the stock already reached the upper edge of the megaphone. So any positivity that we're about to get from the report, it's already accounted for, unless it is stunningly exceeding expectations in a positive manner. I don't believe that the stock will pop higher from this point on. If anything, the report might be impressive, come out impressive, but the stock reaction might disappoint. Next, we have 3M, a stock that I own in my portfolio, and when we look at the different segments, the growth rate for safety and industrial was up 22.4% year over year. The growth rate for transportation and electronics was up about 28% year over year. The healthcare segment was up about 25% year over year. And lastly, the consumer segment was up about 20% year over year. But I'm also looking at the operating margins head to head with the operating margins from last year, because last year this was also a beneficiary of the pandemic. They were able to do price gouging in certain segments of the business. Can they continue to hold these margins with more price gouging due to inflation and perhaps the Delta surge that we got last quarter? When we look at the safety and industrial segment, for example, the margins year over year are actually down. This is expected, of course. Likewise, the margins for the consumer segment is also down year over year. This is also expected because safety and industrial and the consumer segments benefited from the rise in the pandemic last year. On the other hand, we're looking for transportation and electronics and healthcare segments. These segments continue to grow in terms of margins year over year. The challenge is, can the company continue overall to grow year over year in terms of margins? They certainly have the pricing power. Are they flexing their muscles to face this inflation and passing down the extra costs to the end customers? We'll see. When we look at the income sheet, for example, here is the problem with this company. The rate of growth in sales was about 25% year over year, but the rate of growth in expenses was 28% year over year. Very close, but expenses are rising rapidly, exceeding the growth rate in sales. For now, this is okay because the net income came out up about 17% year over year. The problem is, if expenses continue to rise higher and that gap between the growth of sales and expenses continues to widen, then the business will have problems and the stock will crash. And therefore, the only choice for 3M is to flex their pricing power and jack up prices higher to increase the rate of growth in sales year over year. Now, when we look at the chart for 3M, we had the reverse head and shoulder. I bought the stock in anticipation that the reverse head and shoulder pattern will enable the chart to break above the descending sloping line of resistance. And this is exactly what we got. The stock popped higher, but as of late, the last few weeks, the stock pulled back. And this is good. I like my stocks to pull back before earnings. Therefore, the expectations are not going to be high, and beating expectations for the stock to pop higher becomes easier. And again, it all depends on the report. If the stock goes down, yet the report is decent, I will certainly buy the dip because this is one of the stocks that I have in my dividend strategy. Next, we have Visa. We will look at the earnings from last time around. Net revenues were up 27% year over year. The net income, the GAAP net income. You always want to look at the GAAP, not the non-GAAP. The non-GAAP is the cooked version. The GAAP is the non-cooked version. The GAAP net income was up 9%. Everything's looking good here. The key business drivers came from payments volume. And of course, the stock kept moving higher and higher and higher in anticipation of the reopening. The problem is when the speed bump was hit, and the speed bump was the surge in Delta, all of a sudden the stock reacted negatively. We will look at the income sheet. The net revenues, 27% year over year. Operating expenses, growing at 12% year over year. This is not bad at all. It gives you a margin of about 36% and a net income of about 9% year over year. So far, as long as expenses are growing at a slower pace than the growth in revenues, we don't have a problem with this company. But keep an eye at the marketing expenses because last time around they went higher by 54%. When we look at the chart, we had the rising wedge. The rising wedge was broken down. This is a weekly chart, of course. And now we have a bear flag consolidation. The assumption is the bear flag will break to the downside. But watch out here because when you combine the patterns with the momentum indicators, the RSI and the MACD specifically, it looks as if the negative momentum already topped, I should say, which also means that the bullish momentum is bottoming and it's about to surge higher. So you have to keep that in mind. The technicals are conflicting for now. We have one sign indicating that the stock will break to the downside. We have another sign indicating that the stock will climb higher. The resolution will come from earnings. We know that Visa doesn't benefit from credit card transactions when it comes to online shopping. Their margins are a lot smaller from online shopping with Walmart, with Amazon, with Target, yada, yada, yada. But their margins are extremely huge when it comes to small business transactions. What happened during the Delta wave? Small businesses got decimated, and therefore the expectations are that the volume will be down. The setup is good for the stock because the expectations are low. The problem is if the results come below expectations, like really bad, then the stock will move down. But absent of a massive mess here, I believe that the stock will try to work its way higher. Next, we have a big one, Microsoft. I own the stock. I already sold 50% of the position that I have, and I am looking forward to dump the rest. It all depends on the report. I believe that this will be an emperor without any clothes. Microsoft is looked at as this massive growth monster, a Teflon stock. You could have problems with Apple, with Amazon, with Facebook, with Netflix, but you're not going to have any problems with Microsoft. The problem is, what if the growth rate starts to slow down? And here's what I'm talking about. When we look at the last report, every single segment of Microsoft was growing handsomely, with exception of few segments. What I'm looking at this time around is LinkedIn and the Azure, of course. Why LinkedIn? Because the majority of growth last quarter came from this segment, as the anticipation of the reopening, going back to work, yada, yada, yada. Again, what did we have last quarter? The surge of Delta, meaning the spending on LinkedIn, the assumption is, went down quarter over quarter, meaning that the growth rate in Microsoft will slow down. I have no expectations here that the growth in SBUX or the Surface business will recover. These segments benefited tremendously from the pandemic lockdowns last year. And when you pin the year-over-year numbers, they're pretty much impossible to beat. So I'm looking at the Azure business. The rate of growth has been consistent, over 40% year-over-year, quarter-over-quarter. If this growth starts to slow down, then we're going to have a major problem. I do expect it, by the way, to slow down. Another thing to pay attention to is, last time around, Microsoft got hit by the dollar sliding down. As you can see, the currency impact, it shaved 5 to 7% from certain segments. This quarter, the savior could be the rise of the US dollar. So all of these haircuts will be restored to the segments. The problem is, it also depends on the organic growth. of each segment. The currency impact will not save your ass alone. And here is the chart of Microsoft, the weekly chart. Let's see what's going on here. We had a trending channel with defined peaks and valleys. And the chart eventually, of course, broke out of the channel. It went down, it revisited the upper edge of the channel for support, and now it is trading higher. There is nothing bearish in this chart at all from a candlestick pattern. We have a slight divergence here in the RSI, negative divergence from a weekly chart perspective, but again, it all depends on earnings. Now, I believe that this will be an emperor without any clothes, and the chart will pull back to trade inside the channel once again. The chart will continue to rise higher if the revenue from the LinkedIn segment and the Azure segment continue to pop higher and rise higher and higher and higher, which is pretty much impossible to do, but we'll keep an open mind. Next, we have Google, the big Goog. What's going on here? This is the darling of Wall Street this year, the best performing stock among the FANG stocks, certainly among the big cap technology names. But my hunch is that this growth story will also come to an end, because last report we had a 62% growth rate in revenues year over year, and the growth rate for the bottom line was a stunning 266% year over year. The operating margins were clean, almost doubling year over year. This, of course, was expected from the market makers, and therefore they were buying Google in the beginning of the year in anticipation of this earnings report. Now that they got the report, the stock is stagnating in anticipation of a slowing down in the rate of growth in this business. We can, of course, attribute the growth in Google due to the growth in YouTube, because the revenue growth for YouTube was up 184% year over year. This is a stunning number. And rumor has it the growth in the YouTube segment was due to one YouTuber that goes with the name the Maverick of Wall Street. He was single-handedly responsible for the rate of growth in the YouTube segment. The problem is, if Snapchat is right and we're seeing a slowing down in the revenue, then Google will be impacted even more negatively than Snapchat and Facebook. If we indeed seeing the slowing down in the supply chain across the globe, and we have businesses being shy in their ad spending, because why would you spend on ads if you cannot fulfill your customers' orders due to supply chain issues? You're better off cutting your expenses, no ad budget at all, and this will impact the Goog negatively. And therefore I say fade this one, take your profits, and say goodbye. This is the chart from a weekly perspective. And of course, the major question is, we had the accumulation phase, the massive rally higher, and now are we in the distribution phase, which will be followed by a sell-off, a big one? This appears to be the case for now. We have negative divergences on both the RSI and MACD indicators, leading us to believe that the sell-off is about to intensify in this name. Next, we have Boeing. I used to be bullish on this name, giving the company the benefit of the doubt, but it continues to disappoint all of us with more and more problems. Boeing, aka the flying coffin. Speaking of the flying coffin, what about the 737 MAX? This is what I'm looking for, of course. The deliveries. Forget about the margins. We know it's going to be bad. The labor cost is surging higher. The materials costs also surging higher. The market will forgive bad margins from Boeing, but the market needs to see more progress in deliveries. We have a massive backlog of over 4,000 planes, yet they only delivered 79 planes last quarter, including 47 planes of the flying coffin. We need to see more flying coffins being delivered for any bullishness to start in the stock. When we look at the chart, for example, this is a weekly chart. We have a consolidation pattern here of higher lows and lower highs. What will be the resolution? For now, it looks like the breakout will come to the downside unless the earnings report comes out with a save. And the save will be the deliveries number exceeding our expectations. I'm looking for 100 planes minimum, including 50 flying coffins. Next, we have Coca-Cola. What's going on here? Another stock that I own in my portfolio, by the way, so this will be an important week for me. When we look at Coca-Cola, again, old school business, dividend kind of business, solid No problems at all. Any dip you buy, they have a significant pricing power. What else do you need? The problem is the stock hasn't been performing as of late. When we look at the revenues, the growth 42% year over year, again, from a very depressed stage last year. The net income is up 48% year over year. The expenses also surging higher, about 52% year over year. Yet the operating margins remain intact. And so long as the operating margins remain intact, the business is fine. For perspective, of course, we have to compare the numbers from 2021 with the numbers from 2019, before the depressed stage of the pandemic. During the same quarter of 2019, Coca-Cola produced revenues of about $10 billion and a net income of about $2.61 billion. The numbers we have for now, it appears that Coca-Cola is back to the same revenue and net income that they had pre-pandemic, meaning that the company already recovered. The problem is, during the pandemic, they incurred a lot of expenses, adding to the debt and reducing the cash flow. Now, if we assume that the balance sheet and the cash flow sheet will follow the income sheet and recover the pre-pandemic levels, then why isn't the stock trading at pre-pandemic highs? The answer is it is almost at the pre-pandemic highs. What slowed down the stock is the rise of Delta. What does that mean? It means that the expectations are already suppressed. If Coca-Cola turns out to be more resilient in the face of Delta, and we see more sales in stadiums, college football stadiums, colleges, schools, movie theaters, restaurants, then this resiliency will push the stock price higher. And therefore, I continue to hold this name, and I think they have a massive pricing power. In the worst case scenario, this company could flex its pricing power to face inflation or any pandemic disruptions. The chart from a weekly perspective is trading within a defined channel. It appears that it is about to break that channel to the downside. This will be bad, not necessarily that the stock will crash, but it means that this positive momentum of the recovery is coming to an end, and perhaps the chart will consolidate at these levels. It's not the worst case scenario. There are stocks going to flush down 20-30%, as you've seen with Snapchat, for example. This is a steady Eddie kind of stock. It is part of a dividend strategy. So if it consolidates at these levels, I'm not going to have a problem with it at all. Next, we have McDonald's. And this is a little challenging, by the way, because in the report, they don't break out the deliveries number. What I mean, by the way, by deliveries, I mean, did revenues come from dine-in, take-out, or delivery apps like Uber Eats and DoorDash? They don't give you this breakdown, and you have to guess. You have to look at Uber Eats and DoorDash's earnings to figure it out. But my assumption is the majority of growth, if it happens in this company, will come due to the delivery apps, DoorDash and Uber Eats. There is nothing wrong with the sheet here. The revenues went higher, 57% year over year. The expenses continue to rise higher, but they're not denting the net income of the company. We continue to watch the labor cost and how it impacts margins. We know McDonald's is struggling to hire labor. They cannot find the labor. The labor is busy doing OnlyFans and Twitch, so they have to continue to pay higher and higher and higher. And in certain restaurants, the franchise establishments, some of these restaurants are closing down due to the shortage of labor. And this will impact the revenues of Mickey D's. But if the deliveries make up for the loss of revenue from dine-in of certain closure hours, then the company will be fine. When we look at the chart, this is a weekly chart, of course, we have a defined trend, and of course, we have a divergence from the trend line right now. It wouldn't be surprising for the stock to pull back all the way to revisit the trend line, and it will be a steep correction, by the way, if it happens. But it will also be a buying opportunity for the stock, because this is one of these safe stocks. They work fine in good times and in bad times. If we have massive inflation to come, this company will do fine. If we have a depression that's about to come, this company will do fine. Of course, relatively speaking. If we have times of economic boom and moderate inflation, this company will also do fine. Next, we have GM, General Motors. What's going on here? We have the sales numbers across many regions. In the US, the sales are up year over year for Chevy trucks, crossovers, Cadillacs, Buicks, GMCs, all doing fine. The problem is from Chevy cars, the garbage cars that they produce, the Malibu, the Impala, whatever other garbage they produce in sedans. Likewise, when we look at the Asia Pacific, Middle East, and Africa, the sales of Chevys are down. This remains concerning, of course, but the sales of every other segment are growing higher. Here's the problem, though. The numbers are deceiving. When you take out China's numbers alone, here's what you see. This is, of course, from the report last time around. The sales in China are down across the board. All in all, down about 19% year over year. So GM will try to do a nice trick here, a cute trick, by saying that we are having problems over in China and other markets due to the chip shortage. Is it really due to the chip shortage, or is it due to the weakness in the Chinese consumer? And if we do have weakness in the Chinese consumer, brace for impact. Get your underwear, get your diapers, your Kleenex, everything ready, because this will be a leading indicator to a much important report that will come out of Apple, the IMOB. If we have weakness in the Chinese consumer, then Apple will be hit too. So this is the leading indicator for Apple. I know it's weird that GM is a leading indicator for Apple, but it will work this way. We need a pulse on what's going on with the Chinese consumer. And here's my evidence, by the way. In the last report, when we look at the North America segment, we don't have any problems here. The revenue growth is up quarter over quarter, and it's certainly up year over year. So you cannot blame it on a chip shortage here. EV sales are rising higher. When we contrast this image with the sales in China, the number is down year over year, and it is also down quarter over quarter. We're talking about revenues, of course. And this could be a leading indicator that we have a massive problem with the Chinese consumer. Now, what about the chart of GM? What's going on here from a weekly perspective? We have a defined trend, a steep one, of course. I used to own the stock last year. I rotated to Ford, and Ford continues to outperform GM. That doesn't mean that GM stock is bad or anything, but Ford is a much cleaner and neater business than GM. For now, we have the saucer topping formation, and the chart is trying to climb its way back. It continues to rebound over and over and over and over from the trend line. The problem is, from all of the indicators that we have right now, the chip shortage is getting worse. We have a lot of propaganda outlets out there saying that the chip shortage is getting better and inflation will ease, yada, yada, yada. But in reality land, not in ladder land, the chip shortage is getting worse. And if GM comes out and says, you know what, we're not going to be able to produce all of these cars, we're going to have major delays, then you don't have supply to sell, which means your revenue and net income numbers will go down because your expenses are constant, if not growing. But if you're not selling cars, then your revenues will go down, dragging your top and bottom lines down. So you got to be careful here with this stock. Next, we have Ford, and I'm not going to go into details in Ford's numbers because we already went over GM. Ford is probably facing the same problems, the chip shortage, delaying the production over and over and over and over again, to the point where Ford is looking seriously to produce their own chips. That tells us that we have a major problem here in the automotive industry. On top of that, by the way, we have a shortage in aluminum, copper, and magnesium. All of these will impact the productions negatively. Like I said with GM, if you're not selling cars due to the shortages, then your revenues will go down. Your expenses are likely to be constant at best or even growing higher. What does that mean? Your net income will shrink and shrink and shrink until the production resumes. And therefore, perhaps we have a top here in these automotive names. When we look at the chart of Ford, what do we see here? This is a weekly chart, of course. We have a massive pop higher. I bought the stock in anticipation of the stock breaking above the descending sloping line of resistance. This is exactly what happened. And now we have higher highs and higher lows. The problem is it appears as if the chart is stalling here, and we're about to have the dreaded double top formation. I'm not selling any shares because I haven't owned the stock for more than 1 year. I don't want to get taxed on this one, and therefore I'm buying puts on Ford in anticipation of a massive pullback here. Next, we have Merck. What's going on here? I'm not looking at any numbers at all. This stock has been dormant, doing nothing at all, consolidating for over a year in this triangle pattern. The stock only moved higher after the news of the pill, and therefore all eyes are on the pill. Are we about to have good news? What do I mean by good news? More clinical data And most importantly, are they securing government contracts to distribute the pills? And if that is the case, then the stock will move higher. Now, I do own calls for Merck because I was anticipating a pop to break the consolidation pattern, the triangle consolidation pattern. I had no idea, of course, that we're going to have a pill for Merck. But the news came out as a cherry on top, and the stock popped higher, breaking the consolidation pattern. Now it went down. It retested the edge of that consolidation pattern, the upper edge, and it rebounded higher. All of these are good signs that we have what it appears to be an ABC pattern. We had the A leg, we completed the B leg. Are we about to see the C leg higher, which will take the stock all the way to about 88? And if that is the case, then I will continue to hold on these calls, and perhaps at some point I will exercise the calls and buy the stock. Next, we have Caterpillar, a classic inflationary stock, a classic infrastructure stock. Everybody was buying Caterpillar in anticipation of an infrastructure bill, in anticipation of massive spending during the reopening of the economy. And indeed, we saw some recovery in the margins here. We will look at different segments. For construction industries, the revenues, net sales are up 40% year over year. For resource industries, they're up 41% year over year. For energy and transportation, they're up 20% year over year. And then for all other segments, they're up 11% year over year. All in all, sales and revenues were up 29% year over year. This was, of course, a decent report. The problem is the stock already accounted for these good earnings by moving higher at a whack. So now it is consolidating. It pulled back about 25% or more, top to bottom, and it is consolidating for now, waiting and waiting and waiting for the next report. What will make or break the stock? Here it is, the segments by region. All in all, when we look at machinery, energy, and transportation, I'm not looking at any financial products or any of that garbage. I'm looking at machinery, energy, and transportation, the main segments of the business. The growth was up 34% year over year in North America. It was up a stunning 72% year over year in Latin America. It was also up 34% in Europe, Middle East, and Africa year over year. The problem, yet another evidence that we have significant weakness in China. The Asia Pacific region, the growth was up only 12%. So this remains the concerning element. Are we having a hidden bomb in China where the economy and the consumer are weakening significantly? And if that is the case, then we will see those impacts from the reports we're about to get this upcoming week. On top of that, another concern for Caterpillar is the infrastructure bill. We went from $3 trillion to now $2 trillion, probably down to $1.5 trillion, if not less. The stock price went higher in expectations of a minimum of a $3 trillion infrastructure spending bill. This appears to be not happening, at least for now. So we got to be really careful here in the stock. Perhaps we have other better opportunities than buying the dip in Caterpillar. Next, we have SBUX. And again, the numbers are coming out of depressed levels last year as everybody was locked down and nobody was drinking coffee. But now we have the reopening, quote unquote reopening, and people are drinking Starbucks again. And therefore, we're seeing the net revenues for company operated stores up about 85% year over year. Likewise, we're seeing licensed stores. These are the stores that you and I can own. They're up about 126% year over year. Very impressive. All in all, the net revenues are up about 77% year over year. On the other hand, the expenses are only up about 22.5% year over year. Of course, we continue to watch the product and distribution costs due to the shortages and inflation. Last time around, these costs were up 49% year over year. Are they going to continue to go higher and higher and higher? Likewise, what about salaries and labor costs? They were up 24% year over year. Are they going to continue to move higher and higher and higher? The assumption is yes. The main question is, can the growth in revenues maintain the gap with the growth in expenses? If the answer is yes, then the stock continues to move higher and higher and higher. The problem is we also have other distractions when it comes to Starbucks. What am I talking about? I'm talking about Dutch Bros, the name to be in right now. If the earnings report for Starbucks isn't that sexy, then a lot of investors will take profits and rotate to Dutch Bros. And of course, my inner Oregonian, I'm all in with Dutch. No love for Starbucks here, no love for any corporate businesses. We like small businesses in Portland, Oregon, right? Except, for the recent vandalism and homicides. The city used to be heaven on earth. Now it's hell on earth. It's a heartbreaker. Anyhow, what about the chart of Starbucks? This is a weekly chart, of course, and we have what it appears to be a head and shoulder pattern, indicating that the chart could flush down, and the catalyst, of course, could be this slowdown in Chinese stores. Again, with the story of the Chinese slowdown. Next, we have the big one, Apple. What's going on here in the most important name in the market right now? In the last report, the company beat across the board, exceeding all expectations. The so-called super cycle, according to Dan Ives, right? It's not really a product super cycle. It's a cocaine super cycle. What does that mean? It means when you have stimmies all over the place, the masses are going to use the cocaine, the extra cocaine that they have, and they're going to buy gadgets and crap that they don't need from Apple. And therefore, in the beginning of the pandemic, we had the super cycle in iPads. That was rotated to the super cycle of Macs, and then rotated to the super cycle of wearables, and lastly, during the last report, to the super cycle of the iPhone. And now what? After all of these rotations, the only constant growth in this company is the services revenue, aka the shakedown revenue, the iMob revenue, the racketeering operation of the App Store. You see, Tim Apple might have killed Steve Jobs' legacy by turning the company from an innovation powerhouse to a racketeering powerhouse, the iMob, that became a criminal organization that cheats, lies, and steals. And they hide the money over in Ireland while the money is doubling overnight, no taxation whatsoever, and then they use the cash for share buybacks and pump the stock higher and higher and higher. Tim Apple is a genius in delivering stuff, but Steve Jobs is rolling in his grave, knowing what Tim Apple has done to this company. Just look at the research and development expenses. They're not growing at all. This company does not invest at all in R&D. But anyhow, these are the numbers. The product sales were up 37% year over year. The shakedown business, the services business, was up 33% year over year. All in all, the expenses were up 25% year over year. The growth in revenues, once again, exceeding the growth in expenses, and therefore the net income came out at an impressive 93% year over year in growth. I also like to look at the Greater China sales. They were up 58% year over year. This was the most important number heading into the report, but guess what? The iMob delivered once again, and the sales in Greater China were up 58% year over year thanks to the iPhone. Sales for iPhone were up 50% year over year. Sales for Macs were up 16% year over year. Sales for iPad were up 12% year over year. Sales for wearables, home, and accessories were up 36% year over year. And lastly, the growth for the shakedown business was up 33% year over year. Now, we have to put the numbers in perspective because this quarter will go head to head with the same quarter last year. These are the numbers from the same quarter last year. The growth for products was down 2.6% year over year. On the other hand, the growth for the racketeering business was up 16% year over year. All in all, the growth of expenses was less than 1% year over year, yet the net income was also down by more than 7% year over year, and the reason is sales in Greater China were down 29% year over year, specifically for the iPhone. Sales were down about 21% year over year. On the other hand, the growth for Macs, for iPads, for wearables, for the shakedown business were all doing fine. What is the challenge here? This quarter, Apple will have to deliver massive numbers, massive growth ratios, because these numbers are depressed to begin with. What do I mean by that? This quarter, the growth in Greater China should be 100% year over year. The iMob should be able to double the number that you see right in front of you here in Greater China. They should at least deliver $16 billion in sales in Greater China during last quarter. And if they can't do that, then we have a massive problem with the company. Therefore, the expectations are really high for these numbers year over year to deliver. And if they cannot deliver, this will mean the growth is slowing down in the company. And we just experienced the so-called super cycle, the great rotation from product to product to product due to the stimmies worldwide. But now that the stimmies are running dry, what will stimulate sales for this company? Where is the organic growth for this company? Again, this is a China story. And if GM, if Starbucks, if other companies come out indicating that we have a massive weakness in the Chinese market, then you bet that Apple will be impacted too. And if Apple goes down, so will the market. We already cover the chart of Apple pretty much every day, and therefore I'm not going to go over it. You are already familiar with what the chart of Apple looks like. Next, we have another important report from Amazon. Amazon crashed last time around when the report came out. Why? What was the problem for Amazon? As you can see, I'm highlighting for you. The growth in sales year over year was about 43% year over year last year. It went down to 22% last quarter. Yet the business continues to grow in the international segment, be it at a slower pace than last year. Last year was 38%, now they have 36%. The AWS growth continues to be impressive. 29% last year, 37% year over year last quarter. So the problem here comes from the sales in North America. What if last year was the outlier? Due to the pandemic, we have seen a massive surge in sales in Amazon. And now the business is stalling back to normal levels. And it is pretty much impossible to beat the numbers from last year due to the unique conditions of lockdowns. The lockdowns are over now. We can go out and about and shop in other stores. If that is the case, and last year's numbers are the outlier and the business will settle down to regular, quote-unquote regular growth rates, then this will explain the consolidation for over a year in the chart of Amazon. But before we solve the mystery of the chart, is the chart about to break out higher or to the downside? Before we do that, we have to look at what the company is up against. The report from last year for the same quarter. The growth in sales in North America was 39% year over year. The growth for the international segment was 37% year over year, similar to last quarter. The growth in AWS was 29% year over year. Now, what does that mean? Look at the growth of AWS, for example. In 2020 for the same quarter, it was 29% year over year. In the report we got last quarter, it shows that the growth year over year for that same quarter for AWS was also 29% year over year. So the assumption is if there is not a major slowdown in AWS, then Amazon will be able to beat the expectations from the AWS segment. We will look at international sales. The number in 2020 was up 38% year over year. Last quarter it was up 36% year over year. Slightly down, but not a major problem. Likewise, the growth for the same segment year over year for the same quarter, the September quarter, was about 37% year over year. Assuming that Amazon was able to deliver 36% growth year over year last quarter, then the assumption is they will be able to deliver 37% growth year over year this quarter, or very close to that number. So we don't have a problem here in the international or AWS segments. The problem comes from the North American segment. Last quarter, year over year, the company was against a 43% growth rate, which is pretty much impossible to beat, indicating that last year was an outlier. What was the growth rate year over year for the September quarter last year, which we will be up against this time around? The growth rate was 39% year over year. This is, of course, versus 43% growth year over year for the June quarter last year. So during this quarter, Amazon will have a slightly less steep hill to climb. They can beat the number, assuming that the Delta lockdowns, we didn't have an official lockdown, by the way, but a lot of people had a self-imposed lockdown due to the fear of the Delta variant, meaning they sat at home and they ordered stuff from Amazon. Did they order enough stuff to push the sales year over year above 39% in terms of growth? And if that is the case, then the shares will trade higher. But if the growth in sales comes below 39% year over year, then we're going to have the same problem that Amazon faced last quarter. That last year was the outlier and the business will never be able to outmatch last year's numbers. Therefore, the stock will go down. Lastly, on Friday, we have earnings from ABBV and Chevron. Let's start with ABBV. Here are the numbers last time around. The crown jewel of this business is the Humira medicine. The problem is they lost the patent, already expired. So the question is, what will hold the company after Humira? And by the way, I own the stock. It's in my dividend strategy. They pay over 4% dividend. The main concern for me is, what if the stock price crashes? Because what will replace the growth from Humira? That segment continues to grow, be it at a slower pace. And it will continue to grow at a slower pace quarter over quarter, year over year, until the business becomes obsolete. But for now, we have year over year, a growth rate of about 7.1% in sales in North America. For Humira, on the other hand, we have a decline in sales of about 12.6% year over year in the international segment. All in all, the growth rate is slowing down to 3.6% year over year. Of course, all eyes are on the new drug Rinvoq. This is the hope and the dream for ABBV that this particular drug could replace Humira. For now, it continues to grow at a rapid pace, over 100% in the US. International, the business is growing rapidly. But for us ABBV investors, we have all of our eggs in one basket, and this basket happens to be Rinvoq. What if the drug doesn't deliver? This is the risk that you and I have to assume investing in this company. Another important observation is the aesthetics business. When we covered ABBV last time around, I believe in the first quarter of this year, the sales for this segment were down significantly year over year. And I told you all of my hopes are placed on the reopening of the economy because this segment will rebound significantly higher. As people go out and about, all of a sudden they look at the mirror and they say, what happened here? We look ugly. We need a bunch of needles in our faces, from Botox to Juvederm. Let's shoot our faces with stuff to look more attractive, right? When you have that orangutan face, apparently that's more attractive than your regular face. But to each his own, of course. Suit yourself if you want to shoot your face with a bunch of needles. This pandemic left a massive toll on all of us, including myself. I didn't have a single gray hair until this pandemic hit. And now I'm thinking about, the shoe polish strategy, like Dr. Gottlieb. You get the jet black shoe polish and you go over your hair. Problem solved, right? A few more shots in your face, Juvederm, perhaps a facelift, and your confidence levels through the roof to the moon. And therefore, the sales for Botox and Juvederm are surging significantly higher. This was, of course, on par to my expectations. You're going to see a slowdown in the immunology business, but we're going to see a surge in Botox, Juvederm, and other so-called beauty procedures. These sales are up over 100% across all regions for this segment. And before I forget, the oncology business is also growing year over year, about 6.1% in the US and a stunning 38.6% in international markets. Therefore, this is making up to the losses in the Humira segment. But here's the problem for ABBV. When we talk about neuroscience, the segment is growing about 30% year over year. The eye care segment is growing about 24% year over year. No problems whatsoever here. The problem remains in the women's health segment because apparently women, at least in the United States, are not taking the pill anymore. The contraceptive pills, they're not taking those anymore. And this is a phenomenon, by the way, that nobody's talking about. Not the media and even women health magazines. The massive phenomenon of women in America pretty much going commando when it comes to the pill. No protection whatsoever. Why? Because many reasons. The pandemic to begin with. Apparently, we have a crisis in intimacy in America. Take a look, for example, at this article from the Wall Street Journal. It says, feeling too schlubby to have sex? ? It's not just you. And this is, of course, written by Elizabeth Bernstein. She forgot to include her OnlyFans account. But anyhow, this is just a piece from the article to illustrate for you the problem that we're going through. A business owner in Los Angeles who gained 20 pounds during the pandemic says she tries never to be naked in front of her boyfriend, going to bed before he does, showering in different bathroom, and praying that he'll get out of the bed first thing in the morning so I can dodge another bullet. Wow. A realtor in Pittsburgh suggested to his husband that they start sleeping in separate bedrooms, quote unquote, just like royals, so he could avoid being intimate. And of course, I'm assuming this is a gay couple. And let's just hope that our Secretary of Transportation will also lose some intimacy with his husband, because so far he's been swinging on the stupid swing of his while we're having the biggest transportation crisis in this country's history. Anyhow, continuing, a mom in Philadelphia says she feels disgusted with her husband when he tries to get things going on in the bedroom. It is like, what's wrong with him? I'm gross, she says. A writer in Southern California says that when his couple therapists gave him a worksheet on how to spice things up in the bedroom, titled The Sensational Journey, 7 Exercises for Creative Intimacy, a feeling of dread washed over him. And he says, at this point in the pandemic, I'm out of breath just rolling over the sofa watching TV. So, folks, we have another pandemic of men becoming panda bears. They're not interested at all in intimacy. And then we have women suffering from low self-esteem due to the pandemic with weight loss and, the lack of Juvederm. And they're also not interested in intimacy at all. And therefore, no love whatsoever for contraceptive pills. No need. The husband's busy jerking off to OnlyFans, Instagram, and who knows what else. And then we also have the hookup culture, the Tinder, or what have you. Nobody's meeting anymore due to the pandemic and the infections, yada, yada, yada. They're doing FaceTime these days. Let's do a FaceTime and jerk off together. This is what making love means these days. But anyhow, before this show gets any more graphic, let's move on to another segment, the other products segment in ABBV. What about another key product called the Maverick, whatever it is. Don't get too excited here, because it is actually a drug for hepatitis C. But it remains a key driver for growth. Last quarter, for example, sales were up 37.6% year over year in the US market. Therefore, the surge continues. What will replace Humira? This is the problem with a company like AbbVie. They were dependent for a long time on one drug that was extremely profitable, and therefore the company can afford 4% plus in dividend. The problem is, if we don't have another key driver for growth and cash flow, then forget about this dividend. It's going to go away, and then I have no use whatsoever for the stock in my portfolio. And therefore, perhaps the strategy here is short AbbVie and go long Kimberly-Clark, because all of these men jerking off to OnlyFans and Instagram, they're going to need a lot of Kleenex. While the wife and the girlfriend suffers upstairs in the bedroom, looking at the mirror and how horrible and horrendous she looks. And here is the chart of AbbVie. As you can see, we have a trend here. And I bought the stock last time around when the stock went down to retouch the trend line. This was the confirmation that we have a trend, a bullish trend. We have higher lows for now. The trend remains intact. The problem is we have a bear flag pattern here. And if the trend is broken, then what is the point of keeping a stock that pays you 4% plus in dividend, but you're losing 10-20% when the stock moves down? And therefore, I'm watching this one carefully. Lastly, what about Chevron? The numbers last time around were impressive. The upstream business, meaning the gas station, the revenue was up massively, over $3 billion last quarter alone. The downstream business, the extraction of the oil, which has been very challenging, by the way, not just for Chevron, but for all other companies in the oil industry. Yet the revenues recovered to a little over $800 million in the last quarter. Now, these numbers mean nothing because last year, everything was suppressed. There was pretty much no production of oil whatsoever. So we have to look at 2019 and 2018 numbers. Keep these numbers in mind, by the way. About $3.1 billion in revenues in the upstream business, and then we have about $840 million in the downstream business last quarter. In 2018-2019, for the quarter that we're about to receive, the September quarter, the upstream revenue for 2019 was around $2.7 billion. In 2018, it was around $3.3 billion. For the downstream business, the revenue in the September quarter in 2019 was about $828 million. On the other hand, 2018, a better year. Of course, oil prices were higher in 2018 than they were in 2019. The revenue for downstream was around $1.3 billion. So far, so good for Chevron. They're recovering 2019 numbers and then some. Will this quarter show that the recovery is continuing and Chevron has recovered 2018 numbers? Because we now know that oil prices are trading at higher levels than 2018. So why isn't the stock, by the way, trading at all-time highs? The problem comes from the cash flow. The cash flow went down significantly last year. So far, in the trailing 12 months, Chevron has about $10 billion in cash flow, free cash flow. This is getting closer to 2019 and 2018 levels. So again, if there is nothing wrong here with the earnings report and oil prices continue to climb higher and higher and higher, then this is a massively undervalued stock that pays a handsome dividend. Perhaps this stock is better than AbbVie if you want a handsome dividend. And I see no reason whatsoever for the stock to be trading below all-time highs. It should be trading at all-time highs, given the fact that oil prices are recovering, and soon enough we'll have the downstream and upstream businesses in Chevron recovering 2018 numbers. Anyhow, folks, I'm beat up here. My apologies once again for not doing a regular program But I thought earnings deserve our attention right now. But rest assured, we will resume the regular programming this upcoming week, and I will bombard you with the tsunami of videos. So buckle up your seatbelts and keep your head high. Thank you for watching, thank you for listening, and I will talk to you again tomorrow.